Understanding your total loan balance, a comprehensive guide to smart borrowing and repayment. Navigating the world of loans can be a journey filled with opportunities and possibilities. Whether it's pursuing higher education, purchasing a dream home, or starting a new business venture, loans often empower us to achieve our aspirations. However, it's essential to approach borrowing with clarity and a thorough understanding of how loan balances can grow. This comprehensive guide will delve deep into the factors that influence your total loan balance, providing you with the knowledge to make informed decisions and build a strong financial foundation. What is your total loan balance? Your total loan balance represents the full amount you owe on a loan at any given point. It encompasses not only the initial principal you borrowed, but also any accrued interest, fees, or other charges associated with the loan. Understanding this figure is crucial for effective debt management and financial planning. Think of your total loan balance as a dynamic figure that can fluctuate over time, primarily influenced by how well you manage your repayment obligations and the terms and conditions of your loan agreement. Factors that contribute to a growing loan balance. Several factors can contribute to an increase in your total loan balance. Let's explore these in detail. 1. Interest accumulation. The engine of loan growth. Interest is the cornerstone of lending. It represents the cost of borrowing money, allowing lenders to offset the risk they assume by providing you with funds. Interest is typically expressed as a percentage, APR, annual percentage rate, and is calculated on the outstanding principal balance. How interest works. Simple interest. This is calculated only on the principal amount borrowed. For example, a $10,000 loan with a 5% simple interest rate would accrue $500 in interest annually. Compound interest. This type of interest is calculated not only on the principal, but also on the accumulated interest. This means your interest earns interest, leading to faster growth of the loan balance. For instance, if the same $10,000 loan had a 5% compound interest rate, the first year's interest would be $500. In the second year, interest would be calculated on $10,500, resulting in slightly higher interest earnings. Factors affecting interest rates. Credit score. Lenders perceive borrowers with higher credit scores as lower risk and often offer them lower interest rates. Building and maintaining a strong credit history can translate into significant savings on interest payments over the life of a loan. Loan type. Different types of loans carry varying interest rates. For example, secured loans like mortgages typically have lower interest rates than unsecured loans like personal loans. Market conditions. Interest rates fluctuate based on economic factors and market trends. Understanding these dynamics can help you make strategic borrowing decisions, potentially locking in favorable rates when they are available. Example. Let's imagine you take out a $20,000 personal loan with a 7% fixed interest rate and a 5-year repayment term. Using a loan calculator, you can estimate that your monthly payment would be approximately $396. This means you'll pay a total of $23,760 over the life of the loan, with $3,760 representing the total interest paid. Strategies for minimizing interest. Make timely payments. Consistent, on-time payments are crucial for avoiding late fees and penalties, which can increase your overall interest costs. Pay more than the minimum. Whenever possible, consider making payments that exceed the minimum required amount. This accelerates the reduction of your principal balance, leading to less interest accrued over time. Even small extra payments can make a noticeable difference in the long run. Explore refinancing options. Refinancing involves replacing your existing loan with a new one, potentially securing a lower interest rate. This can be particularly beneficial if interest rates have declined since you initially took out the loan. 2. Capitalized interest. Understanding the impact. Interest capitalization occurs when unpaid interest is added to the principal balance of your loan. This means you start accruing interest on the newly increased principal, leading to a faster growth of the total loan balance. When does interest capitalize? During grace periods. Many student loans offer a grace period after graduation before repayment begins. However, interest continues to accrue during this period and may be capitalized, increasing the principal balance when repayment starts. Forbearance or deferment. If you experience financial hardship and are granted a temporary suspension or postponement of loan payments, forbearance or deferment, interest may continue to accrue and be capitalized upon resuming repayment. Example: suppose you have a $30,000 student loan with a 6% interest rate and a 6-month grace period. During the grace period, $900 in interest accrues. If this interest is capitalized, your principal balance increases to $30,900 when repayment begins, resulting in higher monthly payments and more total interest paid over the life of the loan. Strategies for managing capitalized interest. Pay interest during grace periods. If your loan allows it, consider making interest-only payments during grace periods to prevent capitalization and keep your principal balance from growing. Explore income-driven repayment plans. For federal student loans, income-driven repayment plans can help manage monthly payments during periods of financial hardship, potentially minimizing the impact of capitalized interest. 3. Loan fees. Understanding the costs of borrowing. Lenders often charge various fees associated with loan origination, processing, or servicing. These fees can add to your total loan balance and increase your overall borrowing costs. Common loan fees. Origination fees. These are upfront charges assessed by lenders for processing your loan application and dispersing the funds. They are typically expressed as a percentage of the loan amount. Application fees. Some lenders charge a fee for simply applying for a loan, regardless of whether it's approved. Late payment fees. As mentioned earlier, late payments often incur fees, which can significantly increase your total loan cost over time. Prepayment penalties. Some loans may impose penalties if you choose to pay off your loan balance early, potentially offsetting any interest savings you might have gained. Example: imagine you take out a $150,000 mortgage with a 2% origination fee. This would add $3,000 to your total loan balance, increasing the amount you need to repay. Strategies for minimizing loan fees. Shop around and compare lenders. Different lenders offer varying fee structures. Carefully compare loan offers to find the most competitive terms and minimize upfront costs. Negotiate fees. In some cases, you may be able to negotiate with lenders to reduce or waive certain fees, especially if you have a strong credit history or are a long-standing customer. Read the fine print. Before signing any loan agreement, thoroughly review the terms and conditions to understand all associated fees and charges. 4. Variable interest rates. Navigating fluctuations. Some loans come with variable interest rates, meaning the rate can change periodically based on market conditions or an index rate, such as the prime rate. While variable rates can potentially offer lower initial rates compared to fixed rates, they also carry the risk of rising over time, leading to higher monthly payments and a larger total loan balance. How variable rates work. Index rate. Variable rates are typically tied to an index rate, such as the prime rate or LIBOR, London Interbank Offered Rate. Margin. Lenders add a margin to the index rate to determine your specific variable interest rate. Rate adjustments. The frequency of rate adjustments can vary depending on the loan agreement. Some rates adjust monthly, while others may adjust annually or at other specified intervals. Example: suppose you have a $50,000 adjustable rate mortgage with an initial interest rate of 4% tied to the prime rate, plus a margin of 2.5%. If the prime rate increases by 1%, your interest rate would adjust to 5.5%, resulting in higher monthly payments. Strategies for managing variable interest rates. Understand the risks. Be aware of the potential for rate increases and factor this into your financial planning. Consider how your budget would be affected by potential rate hikes. Consider interest rate caps. Some variable rate loans come with interest rate caps, which limit how much the rate can increase over the life of the loan or during specific periods. This can provide some protection against significant rate fluctuations. Explore fixed rate options. If you prefer predictability and want to avoid the risk of rising interest rates, opt for a fixed rate loan. While the initial rate may be slightly higher, it will remain constant throughout the loan term.
Skipping or missing payments, the ripple effect. While we've touched on the impact of late payments, it's crucial to understand the significant consequences of skipping or missing payments altogether. These actions can not only lead to substantial fees and penalties, but also damage your credit score, making it more challenging and costly to borrow in the future. Consequences of skipping or missing payments. Late payment fees. As mentioned earlier, late payment fees are common and can quickly add up. Increased interest rates. Some lenders may increase your interest rate to a penalty APR after a certain number of missed or late payments. Damage to credit score. Payment history is a major factor in your credit score. Missed or late payments can significantly lower your score, impacting your ability to secure loans, rent an apartment, or even get a job. Default. If you fail to make payments for an extended period, your loan may go into default. This can have severe consequences, including wage garnishment, lawsuits, and damage to your credit report that can linger for years. Strategies for avoiding missed payments. Set up automatic payments. Automating your loan payments ensures that you never miss a due date, helping you avoid late fees and penalties. Communicate with your lender. If you anticipate difficulty making a payment, contact your lender proactively. They may be able to offer options such as a temporary payment plan or forbearance to help you navigate a challenging financial situation. Budget carefully and prioritize loan payments. Make sure your budget includes sufficient funds to cover your loan payments. Prioritize these payments to avoid falling behind and incurring penalties. Negative amortization, a debt trap to avoid. Negative amortization occurs when your loan payments are insufficient to cover the accruing interest. This means your loan balance grows with each payment, even though you're making regular payments. This can happen with certain types of adjustable rate mortgages or loans with deferred payment options. How negative amortization works. Payment shortfall. If your payment doesn't cover the full interest accrued, the unpaid interest is added to your principal balance. Growing debt. As your principal balance increases, the amount of interest accrued also increases, creating a cycle of growing debt. Balloon payments. Some loans with negative amortization feature balloon payments, where a large lump sum payment is due at the end of the loan term. This can be a significant financial burden if you haven't planned accordingly. Example: suppose you have a $100,000 mortgage with negative amortization. Your monthly payment is $500, but the interest accrued is $600. This means $100 is added to your principal balance each month, causing your debt to grow. Strategies for avoiding negative amortization. Carefully review loan terms. Thoroughly understand the terms and conditions of any loan, especially adjustable rate mortgages, to ensure it doesn't feature negative amortization. Make payments that cover interest. If you have a loan with negative amortization, strive to make payments that are at least equal to the accruing interest to prevent your debt from growing. Refinance if possible. If you have a loan with negative amortization, explore refinancing options to potentially switch to a loan with a more traditional repayment structure. Adding to your principal balance. Intentional increases. In some situations, you may intentionally increase your loan balance. This can occur when you take out a home equity line of credit, HELOC, or a second mortgage, using your home as collateral to borrow additional funds. While this can provide access to needed capital, it also increases your overall debt burden and can put your home at risk if you're unable to make payments. Strategies for managing increased principal. Borrow responsibly. Carefully consider your needs and ability to repay before taking out additional loans secured by your home. Explore alternative financing options. If possible, explore other financing options that don't require using your home as collateral, such as personal loans or unsecured lines of credit. Prioritize repayment. If you do increase your principal balance, make a plan to prioritize repayment to minimize interest charges and reduce your overall debt burden. Taking control of your loan balance. Understanding the factors that influence your total loan balance is the first step towards taking control of your financial well-being. By adopting proactive strategies and making informed decisions, you can navigate the world of loans with confidence and achieve your goals without being burdened by excessive debt. Key takeaways for smart borrowing and repayment. Budget wisely. Create a realistic budget that accounts for your income, expenses, and loan payments. This will help you avoid overextending yourself financially. Build a strong credit history. Maintaining a good credit score can unlock access to more favorable loan terms, including lower interest rates. Pay your bills on time, keep your credit utilization low, and avoid opening too many new credit accounts in a short period. Shop around and compare loan offers. Don't settle for the first loan you come across. Compare offers from multiple lenders to find the best terms and conditions that align with your needs. Read the fine print. Before signing any loan agreement, thoroughly review all the details, including interest rates, fees, repayment terms, and any potential penalties. Communicate with your lender. If you encounter financial difficulties or anticipate challenges making payments, reach out to your lender promptly. They may be able to offer solutions or alternative payment arrangements. Seek professional guidance. If you need assistance managing your debt or developing a repayment plan, consider consulting a financial advisor or credit counselor. They can provide personalized guidance and support to help you achieve your financial goals. Conclusion: by understanding the factors that influence your total loan balance and implementing responsible borrowing and repayment strategies, you can navigate the world of loans with confidence and achieve your financial aspirations. Remember that knowledge is power when it comes to managing your finances, and taking proactive steps today can pave the way for a brighter financial future.